Look, whether we want to admit it or not, the world of cryptocurrency is growing at such a rate that we're all likely to get engulfed by it in some way, so long as it doesn't implode, which, if we're being honest here, is an option that is likely for various reasons. However, until then, many people are looking into the various ways of making money off of crypto. Now, you might think that this is just an active thing like trying to buy key crypto or stocks of crypto, but you can do things passive if you're smart. So allow us to show you how to make passive income by yield farming. Not truly realistic? Before we get into the details of how these things can boost your yield farm passive income returns, we thought it was necessary to do some due diligence and cover some of the risks involved. All the more reason not to put all of your investment into one investment vehicle. Instead, it is still smart to spread your savings across multiple different crypto and non-crypto passive income sources, even if the rates are lower. Lower rates are often associated with safer investments. Yes, there are risks. Just like there are risks in every venture that concerns many of any type, because trying to make money via a certain system can go wrong if you're not in tune with how that system works. Among the risks are two that we will discuss that are associated with crypto and yield farming: impermanent loss and the flash loan hack. Impermanent loss. To understand this risk, you need to understand the concept of staking. How it works is you buy a token, say BNB, and then you contribute it to a staking pool. By doing this, you aid in making this token easier to trade. And as a reward, you receive passive income in the form of a certain APR of free tokens. Yield farms are similar, except that instead of staking a single token, you are staking a pair of tokens to improve the liquidity or exchangeability of that token. In previous articles, we have likened this to something like a cash register. As you can add change to a cash register, it gets easier and faster to make transactions. So if you add a liquidity pair to a pool or farm, it's easier to trade that token, and the spread, difference between the buy and sell price, gets narrower and more favorable. Similar to staking, you earn free tokens as an APR. But in addition to that, you also earn a portion of the transaction fees associated with that farm. And that gets added on top of your base APR to enhance your yield or return. If you enter a staking pool or a yield farm as the token is trading high, it is possible that the value of the token can drop. You will still earn passive income, but the amount you get in passive income can drop as the pooled value of your token drops too. If you were to then remove your funds from the farm and sell your tokens, you would be selling the tokens for a loss, since the token value had dropped. So, impermanent loss means that this loss in token value can exceed any gains you harvested from your farm. On the other hand, if you were to hold onto your tokens until the token value rose back up to equal or to above what you paid for them, then there would be no loss. Hence the term impermanent or not permanent. Flash loan hack. A flash loan is when an uncollateralized loan is taken out, markets are manipulated, and then the loan is immediately paid back and any difference in token value is pocketed. This very thing happened with PancakeBunny.finance in May of 2021, causing the value of their Bunny token to tank and confidence in their project severely affected. The details of this type of exploit are a bit more complicated, but let's just say don't put all of your eggs in one basket. Needless to say, they have since revamped their security, audits, and roadmap to reflect a new path for themselves. I'm eager to see where their project leads. In addition to exchange and staking, they now have a vault, lending via QBitQBT, and a prediction app similar to PancakeSwap. For example, there are several sites that offer collateralized and over-collateralized loans, Nexo.io, thereby protecting assets from liquidation. Boost, Flip, Zap, Swap, and Vault. These little terms can make you money, believe it or not, and we're here to help you with that. Zap is like an all-in-one button to convert one token to a yield farm's liquidity pair, all with one click. It's really ingenious, and we'll explain it. It actually still uses PancakeSwap's decentralized exchange, DEX, to perform the steps in the background, but it automates the steps for you in a single click. Flip is the Bunny version of LP, where LP stands for liquidity pool. So anywhere it says flip, such as Bunny BNB Flip, that's just their terminology for the Bunny BNB LP pool farm. Boost is where Pancake Bunny starts optimizing your farm rewards. In their Bunny Boost farm, you're earning not only interest paid in cake, but also earning Bunny token too. So if you enter this particular boost farm, be sure to enable your trust wallet to recognize Bunny, as it will be deposited in your wallet as you earn interest. Anywhere that you see Maximizer in the pool, that means that the site will auto-compound your cake profits and at a frequency that does not cause a loss from transaction fees. Swap is their term for the portion of transaction fees that you earn from staking in a farm. We'll see these terms later, just so you know. And Vault allows you to lock your tokens, and the Vault will then auto-compound your gains by buying more of the same token of the Vault, thereby increasing your Vault balance automatically. These automatic features save time, transaction fees, and steps that make yield farming more efficient and more profitable. Next, we'll do a walkthrough so that we can see all these terms in action and how they affect your funds and profits. Step by step. Let's do a walkthrough on one of Pancake Bunny's farms, the Bunny BNB Flip Farm, which will earn both cake and bunny. And as a reminder, please note the inherent risks of participating in staking pools. Step number 1. Make sure to enable Bunny and Cake in your trust wallet so that it'll recognize the interest you earn in Bunny and Cake. Step number 2. Go to pancakebunny.finance and find a pool that you'd like to stake funds. In this case, I will do the Bunny BNB Flip. Remember, Flip is just their term for LP. Determine how much BNB or other token you want to stake, then press Zap when the button activates to turn BNB directly into the Bunny BNB Flip pair in one click. Step number 3. Next, enter the amount of Bunny BNB Flip you'd like to stake, or hit max to stake the full amount. Next, simply confirm the transaction in your trust wallet. Remember that the vault or pool may optimize the frequency that it claims Bunny, but eventually you will start to see free Bunny show up in your trust wallet. The cake you earn will be automatically reinvested in any Maximizer pool or vault. That should get you set up. A more basic approach. The most basic approach to yield farming is to lend digital coins, such as DAI or Tether, through a dApp such as Compound, which then lends the coins to borrowers who often use them for speculation. Interest rates vary with demand, but for every day's participation in the Compound service, you get new comp coins as well as interest and other fees. If the comp token appreciates, and it's more than doubled in value since mid-June, your returns skyrocket as well. But obviously, there is always a risk in this, and we have to reiterate that. Beware the perils of crypto. As you might expect, anything attached to cryptocurrency has a warning label, if you will, because while it has lasted much longer than people expected it to, that doesn't mean it's without pitfalls, as we've expressed. The most important thing is that you don't go and invest everything you have into any type of crypto plan, because if something happens to crypto, you're the one left holding the bag, and no one wants that. Can yield farming be the thing to help you grow your portfolio? Sure, but be mindful of where you do it, how you do it, what coins you do it with, and how the market looks as you are starting to do it. You'll thank us in the long run. So, what do you think? What do you think of this look at yield farming and how you can possibly make money off of it if you farm it right? Did how we describe it make sense to you overall? Or do you think you'd need more of a hands-on demonstration to really get a feel for what's going to happen? Let us know in the comments below, and we'll see you next time on the channel.